Hi there, folks. Sean Broderick, and I'm here in Boca Raton, and I'm speaking to Mr. Curtis Hicks. He's the Chief Financial Officer of Vermilion Energy, which is a great Canadian oil and gas play, but more than that. I mean, that's what I really knew it as coming into this conversation, but I found out so much more, and it's really interesting, and he's going to give you the scoop. Could you please speak to my subscribers?
Sure, Sean. We are a unique story in the oil and gas space. We've got assets in North America, Europe, and Australia. So we're diversified globally. It's a self-funded business model, and by that I mean that our cash flow from operations is sufficient to support our capital program as well as pay a dividend to our shareholders. And generally, there's a little bit of money left over. We use in the short term to pay down our debt, and that becomes available for our long-term M&A strategy.
Okay, now, one thing that's really helped your company is you have global reach. So when the price of, say, natural gas is cheap here in North America, you can sell it in Europe for much more. Could you speak about that a little bit?
Sure. Again, it's all about the value of diversification. We're selling what we think are four products. We sell oil priced off of WTI in North America. We sell oil priced off of Brent in France and Australia. And we sell North American gas priced off of AECO in Western Canada. And we sell European gas, which is priced quite differently than it is in North America. So we're selling today gas in Europe, for about $7 Canadian an MCF, whereas in Canada we're getting just over $2 an MCF. So there's a huge difference. And as we saw oil prices drop late 2014 and through 15 and 16, we were still selling gas in Europe for roughly $7 an MCF. So that helped bridge the gap for Vermilion through this recent downturn in oil prices.
Well, actually, I'm glad that you brought that up, because a lot of these oil producers really struggle through that. But your company used that wisely, and you really cut costs. Could you speak about that a bit?
Yes, we took an approach where we were in an oil price environment that we suggested was going to be lower for longer. So in order to manage through that, we took a strong look at our cost structure, OPEX, CAPEX, G&A, and we kind of went through the structure, reduced costs. I think we pulled $100 million out of our cost structure in 2015. Took another 60 or 70 million out in 2016. So we've made a significant improvement in our overall cost structure, to say nothing of the capital efficiencies that we've been able to generate. We're down 84% over the last 5-6 years in terms of our F&D costs, which really goes to the bottom line. We're able to deliver the same product growth for substantially less capital than what we used to invest back 5 or 6 years ago.
Excellent. And also people will probably want to know about your dividend. Could you speak to that a bit too?
Yes. So the dividend to Vermilion is a fundamental component of our strategy. We started paying the dividend in 2003, and at the time, the message from our shareholders was very clear. They wanted reliable, consistent dividends over time. So since 2003, we've never reduced the dividend. We've increased it 3 times, and we continued to pay it, through the downturn, late 14 through 16. So, we paid $2.58 a share per month. It's in Canadian dollars. And at some point, when we feel like there's some price stability in the oil price market, we'd like to get back to dividend growth.
Okay, and one important thing is that even when we had the oil market a downturn, your company kept paying its dividend when, like many others, just could not do that, which I think is important.
Yeah, it's important to note that we do run a conservative business model. We keep the balance sheet fairly clean. So going into 2015, we had a fairly low leverage on our balance sheet, so we were able to continue to pay the dividend through the downturn. Our leverage went up automatically, as did everybody else's, but it didn't go to levels that really put us in a situation where we couldn't execute on the business plan, or where our debt holders were knocking on the door. So we've kept our leverage ratios well under industry average, and we still are there, and so that's been helpful. But again, the dividend is very important to us, and as this downturn was relatively short-term in nature, we've been through a few others in my career that have been a little longer and a little more painful. This one has been somewhat painful, but we were able to maintain the dividend, and certainly we're in a very comfortable position today with where commodity prices are globally.
Okay, and one last thing is that you have all this, plus you have really good production growth as well, and you have that planned out as well. So I think you should speak to that a little bit as well.
Yeah, our strategy really is to deliver modest production growth on a per share basis. We want to deliver 5 to 7% production per share each year, and combine that with the dividend yield, which today is roughly 6%. So we think that that combination of modest production growth and dividend yield is really a good investment vehicle. We've had that feedback from lots of investors that they like it. We believe that high production growth business in the energy space is very difficult to achieve on a long-term basis. So we think it's prudent to have more discipline in the capital investment, spend less money, deliver a bit less growth, but then deliver the dividend. So you get that cash return immediately.
All this, and they're growing their resource base as well. And I think you and I can think of some very large oil companies that have not been able to accomplish that. So that's all great stuff. Is there anything else you would like to mention before we go?
Well, Sean, I think we've covered the basis, for Vermilion and the reasons why we think it's a good long-term investment. If you look at our track record, certainly we've outperformed most of the major indices over any time slice that you want to look at, whether it's 1 year, 3 year, 5 years, or 20 years over the life of the company. Mm-hmm. And so, we think it's a good long-term value investment.
Okay, great. Well, this is Sean Broderick in Boca Raton speaking to Vermilion Energy. Fascinating company. We're definitely going to take a closer look at this one. Has a nice dividend, production growth, resource growth, seems to be hitting all the boxes, and so definitely worth a second look. We will take a closer look. Thanks for tuning in, folks. Thank you for speaking to my subscribers. You folks stay tuned for more.
Thanks, Sean.